Very good afternoon, everyone. Welcome to our quarterly meeting with our investors and analyst community. We'd like to welcome you all here. It's the usual format. Of course, you've seen our half-yearly results. I believe that they are in keeping with the guidance we've been giving you as we go through these 2 years of the hiatus between projects in Duqm, but where the rest of the business is picking up to compensate for that period. Without further ado, we'll open it up to your questions to give you the maximum time during this hour. Thank you very much indeed. If anyone has the first question, please go ahead. Hi, Samir. Can you hear us?
Hello. Can you hear me? Hi.
Yes.
Hey, gentlemen. How are you doing?
Very well. Yourself?
All good. All good. Thanks for the call. And a great set of number in Q2. So just have a couple of questions especially on your RSVD. So you last time guided for almost 6,000 plus level of occupancy by end of this year, and almost 50%. I mean close to 10,000 levels by 2025. So do you still stick with your guidance?
So yes, Samir. Although these guidance we give will be based on known commitments we've got, but those commitments will depend on actual project starting dates for our customers. So what's happened since we last spoke? I think we were averaging around 4,500 during the last quarter, and we said that we expected that to come up to 6,000 by the end of the year. Now, where we're at today, and it's happened just starting in the second half of the year, we're at 5,500 now. So it's gone up 1,000 when we were last speaking. This is primarily from existing clients, what we call the permanent base. Remember, we described that we will have upswings of temporary boosts in accommodation when there are project teams working, but each project that finishes leaves behind a residual permanent workforce. And that residual workforce is of that 5,500, over 4,000 of them are part of the permanent workforce. Now, in terms of the crossing 6,000 as we go towards the end of the year, there's some temporary things. We've got another military exercise that will happen between Omani and other friendly forces. We've got so that will be temporary, a boost of accommodation. But the projects that we see coming first are these green hydrogen projects. There are 3 of them expected in Duqm. So one of them has started the ground preparation. So part of our current occupancy includes the contractor who is doing the ground preparation for that project. Now, we understand that with the green hydrogen projects, the green steel projects, I was thinking of it unintentionally, the green steel projects, the 3 of them, they require gas and guaranteed gas offtake as the cleaner energy to use while they transition to renewable energy as more and more renewable energy sources come into Duqm. So what we hear is there's some discussion going on between those 3 projects and the government over the gas allocations. Once that is sorted out, then we'll see their actual start dates. Now, as it stands in our information, we're expecting we've got one of those projects where they're always the first team on the ground for ground preparation. and there are other contractors lined up for that project, who've all booked with us once they get the green light to go ahead. A second project may also start within this calendar year. And the third one is due to start during 2025. So those green steel projects are expected to bring us up beyond the 6,000 by the end of this year and further improve numbers in 2025. We also expecting, and we know that government and OQ8 are looking at expansion of the refinery. They're looking at the next downstream project, which will be the petchem project. For that, we're not expecting any numbers in this year, but we are expecting some sort of announcement signal during the year. Thank you.
Got you. One follow-up question. So what kind of occupancy is required for RSVD to break even at net profit level?
So Samir, I think this question was asked of me last time as well. And I've given the answer that the EBITDA break even has been brought down to the 3,500 level. When you talk of profitability, that number would be around 4,700 at a book level, depending on the mix. So it's not just an absolute number that at 4,700, it depends on the room mix, whether it's 1 PR, 2 PR, 3, 4, 6, 4, 8. So that is how it works. So we foresee a very positive momentum for the CUM, given that the awards have started happening, and one of the steel projects, as Steve mentioned, has started the ground leveling and road infrastructure, which is already mobilized. We expect 2 or 3 more awards to happen during the year, and then the other 2 steel projects to mobilize towards either Q4 or Q1 of 25.
That's very clear. And one last question from my side. You mentioned about 2 new projects on smart meter and one other project as well. I don't remember exactly, on waste water treatment. How big is the size of these projects, and how what kind of margins are you expecting on this?
So, yeah, I'm not going to get into competitive information on margins, although as a general comment, you know, if you look at our, we're in very highly competitive business in soft services, pure services contracts. Those are normal type margins. Then as you move into this area, utilities and waste management, when you move into our accommodation services, where you get economies of scale and the occupancies are high, those move into different higher levels of margin. So it's a positive margin business to be in the utility sector, but I don't want to get into specifics. Now, what happened with the, and I can't recall, Samir, at which stage you know, when we were talking about there's a major tender out, etc. Now that tender got postponed, but what happened was we were awarded the smart meter rollout for the area in which we operate, which is the capital area, the 3 zones of the capital. And so that's all happening during this year and is contributing to performance. Will run into next year as well. Now, there are a couple of other tenders out. So on the water meter front, a similar one for the 3 zones in the capital area. Now, on the water, we operate zone 1, and there are 2 other operators in zones 2 or 3, but all 3 zones are out. And you know, we fully respect competition, but we expect to be as an incumbent very defensive of our zone 1, and we're targeting to win one of the other 2 zones as a desired outcome. Expect to hear an outcome of that shortly. So in that area, there's, instead of that one massive bid, it's coming out more incrementally. But it is coming out, and it's there's plenty to do and plenty of opportunity coming by utility service.
That's clear, Steve. Thank you, Steve and Rashid.
Thanks, Samir. Hi, Joyce. Joyce, can you hear us?
Yes.
Joyce, I think you're on mute.
Good afternoon, gentlemen. Thank you very much for taking the question. Could you please give us some color on the pack business? Because what I understand is you have mentioned there is a enhanced mobilization for the increased capacity. And could you please give us some color on what's the occupancy level right now, and how are we progressing on into the third quarter, and probably where are we likely to end at the end of this year?
So, in our pack business, we've described to you how there are sort of 30,000 beds out in the PDO oil and gas field. 15,000 of those are packed beds, and we previously had 8,000 of those. So today we're at 10,100 of those having expanded. And so out of the 15,000, it's now at about 17,500 beds in the pack community. So the benefit of that, of course, we're building a modular solution to meet the timeline that they needed the expansion done. And that's there to be there for a temporary period. So we're recovering the investment of that over 3 years. And the benefit and the profitability of that, like with all higher occupancies, you start moving into economies of scale. So obviously that flows to the bottom line. And there's another reason why you're seeing that in spite of the downturn, this 2-year hiatus of Dukkam, we're going through the second year, we're coming to the end of that, is being compensated by these other factors, the growth in our pack business, and better performance in other contract services businesses. So that's where the pack's at. I can also, and I know you haven't asked about this, but also the new Manalvo tender is coming out. Remember, huge effort we made in competing for the original version, but it's now coming out in a different version, where first and foremost, the existing packs, including operations in all locations, are part of the solution. They are going to be part of the solution at the minimum until 2044, and then beyond that, if the concession to PDO is extended beyond to 2044. So within that tender, there is a delta of so some of these temporary beds will convert into shutdown camps. And the packs themselves, there will either be a new pack where there are existing packs, or existing packs will expand, will expand. Now, that, of course, is a tremendous advantage to us and other pack operators, of which we are, we have in 65% of that business. Where we should be able to leverage expansion ought to be more competitive than building a whole brand new infrastructure. And the net gain of that is going to be another 7,500 beds of expanded packs. And the second piece of that is going to be another 10,000 beds that will come as centralized contractor camps, modular, in all the locations, the 6 locations where there are no camps at the moment. So the scale of this opportunity coming towards us is another 17,500 beds, of which, if you follow our success rate, we have always won the maximum we can, because these things, quite rightly, we understand clients want to have competitive tension, and we'll have different operators in other areas. So if we were to win our share of that, there's a chance of almost doubling this business that we have again. That is over. The request for it of interest has come out. That will be followed by the tender document. That will be followed by the competition, then the award, and then it's got to be built. But in terms of the business we're in, and where we're successful at that, there's tremendous opportunity coming down the track for further pack expansion. Thank you.
Okay, thank you, Steve. Can you give us some color on the occupancy levels that currently we are in?
Yeah,
and how are we progressing on?
Yes, of the expanded capacity, we're just around 90%. We were expecting to be above 90% just now, so we're just under that. But it's going well, and we're actually full in several locations. We've got 2 locations that are below our expectation, having expanded, and below our client's expectation. It's not a complaint. This is the reality of how things have worked out, and delays of contract awards, etc., in their own side of the business. So that is also coming. So we're expecting to get, I can't put an exact date on it, but we expect it during this year to cross that 90% again of the new expanded capacity, and see the benefits of that flowing later in the year.
Got it. And another question that I have is to Rashid. Rashid, we are seeing some expansion in the EBITDA margin during this quarter, specifically from 21% to 23%. What are the reasons that led to this improvement in EBITDA margins? If you can elaborate on that, it would be very helpful.
So thanks, Joyce. I think I mentioned it last time as well in the call that the theme that we're following is very simple. We are looking at individual contract profitability, improved efficiencies across our processes that can be replicated as we move forward. Then both these combine into what we look at from an ops excellence angle to make each and everything efficient while giving the same or better customer experience, and continue to manage our overheads as efficiently and closely as we can. All this combined has led to better margins on the EBITDA level and the operating profit level. If you see, when you compare it to the last quarter, when I say last quarter if you compare it to the quarters of H1 23, we've come out much better. All the efforts and the initiatives that we're driving to make us more lean, more mean in terms of how we execute in the field are slowly and steadily showing results in the question that you asked on EBITDA, as well as I'm expanding it to operating profit as well. So that is it. I wish I could give you contract specifics, but we don't discuss individual metrics. I think you've seen, and Steve's explained, Dukum, so which gives you color that the other part of our business, which is the heart of our contract services business, is firing on all cylinders.
Yeah, thank you. So how much further room do we see for improvement in EBITDA? If we can just share some insights, that would be very helpful.
Look, it's a journey. We've embarked on this journey. We are seeing the results come quarter on quarter on quarter. Once, as Steve said, Tukum reaches 6,000, you will see some really good numbers flowing through, because I think we've done what we had to do in Tukum. Now, I wouldn't call it a wait and watch. Now it's just as we fill up, you'll see a much healthier bottom line coming through. That's all I can say. We will continue to improve. We are looking at each and every contract with a fine-tooth comb to make sure it's efficient. It's how we want it to run, and we're also talking to our clients where we see any opportunity which can be passed on to our clients to make it a win-win for both us and our clients. And the many initiatives that we're doing around water conservation, around managing air conditioning, and we can talk about it. There are many initiatives from technology and digitization point of view, and measuring what we are doing and improving in the sense where we improve our bottom line and remain sustainable, which is, the core of what we want to achieve as we go along.
Yeah, I mean, to absolutely support the way Rashid's framed that. It brings us back to what we've spoken about in this forum before, our Renaissance 2.0 strategy. And so, yes, that excellent work that has been done by Rashid and our colleagues on operation excellence and other issues. But if you come back to that sort of issue, and we talk about our vision, we want to lead the future in those 4 words: smart, sustainable services solutions. So we've got our services. A lot of what we do is we respond to clients' tenders, and they ask for a service, we offer it, and then we have the exchange of providing that service, getting paid for it. And it's having that solutions piece, which Rashid was saying there. We want to take a lot of these smart things, a lot of the automation that we've brought in, a lot of the technology we're bringing into the business, whether it's on, as said, energy consumption, reducing water usage, food waste, a whole range of initiatives. How do we turn that into services that we can also provide for our clients, not just in those places where we operate that ourselves? So by getting greener in what we're doing, getting smarter with the technologies that we're using, bringing solutions to our clients, that's where you're seeing this performance holding up in spite of that enormous downturn in this hiatus period in Dukkha. And it's a range of these things that are contributing to it. And I'm just linking not just the story of what we've done and doing, but it's very much at the heart of our strategy. Thank you.
That's very clear, gentlemen. Can you touch upon your international operations? You've been trying over the past several years. We've been trying in Qatar and Saudi. Is there any updates that is worth sharing at the moment?
So no, nothing new or dramatic. It's been very slow churn of opportunities coming up in Qatar post World Cup. That's like over the last 2 years. It's quite slow. And of course, we're the newcomer on the book. Saudi, we now established the office there. We're looking at opportunities. We've talked to you about the PPP opportunities that we've already bid that would be transformational if we are successful with any of those, because it gives you a very large Trojan horse to enter a market with. But yeah, no major breakthroughs there, but much increased activity on our part. But we don't have a success story to tell you, other than each time we're learning and looking at opportunities that we can get there. For example, there are 2 new PPP opportunities in Saudi, one in the oil and gas space, one in the education space. And these are in our sweet spot where people are looking for staff accommodation and so on. So it's The opportunities are coming, but we don't have a story to tell yet.
Got it.
One
Understood.
comment, sorry, after you, John, please.
Yep. Thank you. Thank you for that. And any other service level contracts or any other tenders are
Yeah.
upcoming in the future, in the near future?
That's what I was going to add. That's what I said. You're on the money. One of the things we've noticed, I don't know all of you, and but very much an integral part of this great market of ours. If you've noticed, in the last couple of years, even as I'd say, even as a post-COVID issue, how, not just in our sector, how many opportunities come, tender opportunities, etc. And what used to be a pattern of, what date they're deciding on, they've got to mobilize by then, that's going to happen. And there was, to my mind, a much more certain timeline on things. Now there's a pattern of a lot of change coming, even sort of mid-tender or late, tenders, and revised BAPO offers and revised starting dates. It's become, something of a habit, and it's fine. The markets change and things. So we've still got a number of tenders in play, in which one always hears rumors, etc. I can't get into that. In which we are, serious contenders, of which, if a couple of them were awarded quickly now in this year, some would start in this year and start to contribute. So, when Rashid answered the point about what do we think the bit is going to go, etc., this is another factor. We always build a bridge as to, okay, what if these things happened? It would be, but we're reliant on those things and fully respectful of when the clients are ready to make that commitment, say, right, let's go. And then, of course, we have to be the winner. But we've got some important tenders out there that would not just have an impact towards the end of this year, but would have a great impact over the next few years.
Fine. Thank you very much, gentlemen. That's it from my side.
Thank you, Joyce. Hi, Sundar. So Dishan wanted to speak, but let's go.
Hi. How are you? Steve,
Hey,
it's been a while, I think. It's Sundar.
Hi, Sundar.
Thanks, Rashid. A couple of questions from my end. Just want to clarify on the latest the rules which came in this time, Omanization rules and certain visa restrictions. Do you see any impact in your end, or how do you are placed? Because this has been a kind of specific related to the lower end of the job. Your blue collar jobs are included in this. Do you see any impact? That's my first question. And on the second question, I was seeing your balance sheet. If you compare to the Q1 and Q2, I could see the financial assets. Basically, you have a book of investment book closer to, it used to be around 15 million, and that has come down now. Primarily, I could see the current assets, especially the financial assets in the current side, has come down. Is it related to dividend payment or any sale you did it in the Q1?
So I'll take both on. In terms of the labor law that came out in June last year, the royal decree, we went ahead and booked all our accruals as per what was required by the royal decree in December of last year. And since Jan onwards, we've been moving ahead with the new compliances that are required both for expat as well as our Omani colleagues. So that is done. In terms of your question on visa, etc., we as a company have been in the forefront when it comes to our Omanization targets and our Omanization percentages across the spectrum from the head office down to the sites. at certain sites, it's closer to 70% Omani colleagues running projects. Does that answer your question, or you want me to elaborate any further?
Add
Yeah.
something to it, Rashid, and then we'll go to the balance sheet, which Rashid will answer just a second. So, that point that my colleagues just made is the basis of where we come on this. So first of all, if new rules come out that anyone in this job category has to be Omani, or in this type of department has to be Omani, we are a company that is compliant. So to us, so we accept that something new comes out. Now, we're also a company that is recognized by the authorities, including the Ministry of Labour, as part of the solution. Rashid's just referred to where we've got contractors, 70 and 80% urbanization. We've got some contracts and smaller contracts that might have a small amount of urbanization because of the types of jobs and the location and availability of local workforce, etc. Now, one of the things that we're very, very keen on in our company, that whilst clearly we have a policy that we favour Omani candidates, and we go out and look for Omani candidates specifically for some jobs, it's only Omani colleagues we're looking for. We also, as this country does, values the contribution of expats and what they've done to build the economy, etc. And many of our blue-collar jobs are in those categories where there are more of jobs than available local colleagues to join, or even the attractiveness of those jobs. So a lot of our automation is about making jobs more attractive, etc., get more Omani colleagues in and so on. But if we see an exception, so there are some things like where, construction companies have large numbers of expats as well as their Omani, etc. So too at the blue collar end, we will have that. We therefore need to have language-wise expats to look after them and so on. But we go to the authorities and say, look, this is what we've got. This we need an exception for this reason, because this is part of the solution. It's part of building this economy, not a part of just we're trying to keep expats in these jobs for the sake of it. So we really value our expats. We want them to feel safe and secure in their jobs, the same as our Omani colleagues are. And as we grow, it's more Omanis coming in and our expats are sort of spreading out, but we're keeping job security for them. And these new rules, we always comply with the new rules, and where there are exceptions required and justifiable, we take that to the authorities, and we've always found them willing to listen. Because we're not bringing a spurious case for it. So we don't see it as something that will harm our business, is the essence of your question. Right, back to your balance sheet.
On the balance sheet, so there your question was around investments and cash and bank balances.
Correct.
Yeah.
The investments, especially from Q1 to Q2, yeah.
Yeah, so the investments also include the money that we invest on a short-term basis in money market funds. Yeah. If you look at it in totality, in June 2023, our balance was around 20.5 billion, which if you add up both as of 2024 is 15.7. So the movement is approximately 4.8 to 5 million of a decrease. It is attributable to actually three key aspects, and I'll talk about them. One, you touched upon, which is the dividend, which was we gave a one-off higher dividend after 10 years of 30 paisa per share. The second thing is that Steve talked about the increase in beds from 8,500 to 10,100. We did that out of internal accruals. We did not borrow for it, and that investment was in the range of 7.5 to 8 million. And the third factor that is contributing to it is we've paid 2 installments of Project Wings during the year, and we've prepaid one of our local loan in the first quarter amounting to 1.3. So that is 5.3 plus the 7 for the temporary expansion, modular expansion that we had at the tax and the dividends. So essentially, if you do your maths, our cash reserve could have grown, but we funded everything through internal accruals. A good story to share is when we closed the year, our day sales outstanding was around 175 days. As of 30th June, it stands at 147. So massive drive on collection, which is our day-to-day, how we breathe and do business, because otherwise we won't survive. So that is the movement in your cash and investments combined.
Yeah, it's pretty clear, Rashid. I think now it makes sense. I think that's what I was thinking. And do you have any view on this, the current portion which you have? We have around another 15 million. Do you want, or you will have a similar strategy, or what is your view on this? Because you have your debt and you have your investments. How do you want to look at a perspective when the interest rates are coming down? I'm sure you have your investments in pretty safer, or the bond investment. You need to see through. Yeah, just on your perspective, how you're going to do any strategy on that?
You know, we look at various opportunities in terms of is there an opportunity to invest? We are always on the lookout for both in terms of growth organically and inorganically. At the moment, we're very proud to say, you know, we're self-sufficient to generating cash. I would refer to us as a cash-rich company. We have all our cash invested in safe and secure, I'll call it not vehicles, but whether it's the MMFs or call deposits, very safely earning us money till such time it is required. We like to keep that the cash with us because on a daily, I won't call it daily, but on a regular basis, we come up with many opportunities whereby we may consider that we need to move fast and invest. So we keep that cash heavily sitting with us, just in case we have any opportunity, we can deploy it. And that's about it. Meaning there's no outlook as such, but the investments are secure, they're very stable and safe.
Thank you, Rashid. My only concern is because the yields are going to come down. Eventually, you'll have lower yield at some point of time. Whether it makes sense to pay your debt or keep your cash. That is what my view. Yeah.
So the third option is always to pay down debt, but at this point of time, yes, yields may come down. The repo rate remains at 6%. So I think we'll wait and watch. Is what I'd say. I don't want to predict or you know, take a shot at the future.
Yeah, you know, in reality, debt is cheaper than equity, and we're always trying to balance this equation. I mean, it's something that Rashid and his treasury team are always looking at. What is the optimum? And so we you know, we want to sustain our banking relationships as well. So it's not that we wanted to bring down all the debt and not have those ongoing relationships, etc. So some of it's keeping your powder dry for the right opportunity when it comes. The other is being in a position to be able to pay. Remember, we said we want to pay regular and consistent dividend. We're glad we weren't consistent last year. We went up from our normal, so that we have what we wanted to keep doing with cash, as well as you know, we've been through a bit of a dry period of the kind of opportunities. I'm not saying there's a major M&A effect, but we've got some interesting, you know, irons in the fire that we're looking at. Early stages, so you want to have your cash available for the equity for that as well.
Yeah. Thank you, Steve and Rashid. Thanks for that.
Thanks, Sundar. I think Bishan had raised. his
Yeah,
hand.
Bishan, you were.
Yes. I think we answered the first question. Could you provide the occupancy in RSVD currently to show? Deepak. Can you go to Deepak? Hey, Deepak, can you hear us? Hey, Deepak?
Yeah, hi, I can hear you. Please go on.
Okay, so the RSVD current occupancy is just about 4 to 26%. As Steve mentioned earlier, it's at the 5,500, 5,600 levels. It's 1,000 above where we closed H1. It's looking promising. As Steve mentioned, contract awards are happening. Although it's at the moment one of the green steel projects, we expect everything, although slightly delayed, to happen whether it's Q4 or Q1 25. So that's the visibility we have. We have the known demand and we have the unknown demand. The good thing is that out of the 5,600 that we have currently, close to 80% is permanent. And that is really heartening. And at this point of time, that's all I can tell you. We have an extremely bullish and positive outlook towards what's going to happen at Dukum. Steve's attended and he can give you more color on the Dukum forum that happened and the attendance and the focus there is on Dukum.
Yeah, I mean, we've discussed this in this forum before, but I think everyone can see what the government's invested in Dukum already. And that is not going to be a squandered investment of all the infrastructure, the roads, the dry dock, the port, the refinery, amongst other things. And all of those things are designed for the refinery, both designed to have additional upstream and downstream activity around them. So that's going to come naturally from that. But there really is a push in Dukum and an international purview that Dukum can be almost uniquely because it's got space and it's got all the attributes to be very, very strong on renewables. It's got wind farm, it's got plenty of free acreage and so on. To really become a green industrial project promotion zone, hence the 3 green steel projects looking at and so on. And so although we can all be frustrated about, when these things actually going to get signed on the dotted line and move forward, there's really positive momentum there and a very positive long-term view. I mean, BP have independently been looking at sites for wind renewables around the world, and Dukum came out #1 on their list. So there's projects we don't talk about yet because we don't have any actual firm color on them, where the oil and gas companies are looking at Dukum for some renewable as they do their transitions, carrying on with the hydrocarbons, of course, but looking to have more and more renewables in their portfolio. Yeah. Yes.
Deepak, you had a question on tax.
Yeah, that's right. This
And,
seems to be higher
last
this
year.
year.
So I think this is the 3rd time I'm explaining this. So it's a little bit complex. It's not as simple. Last year we didn't have any tax provisions. The only entity where we were accruing for tax was our joint venture, Renaissance Sagar. Renaissance made a divestment in 2019 against which it booked a loss of 52.5 million riyals. And that loss was in our books and we were using that loss as a tax shield for 19, 20, 21, 22, 23, and 24. Because that loss was becoming time bound for the tax authorities, as of 31 December 2023, they disallowed the entire loss. Since they disallowed the loss, we booked a tax provision in our books for which we had already accrued. We had already accrued for that in anticipation that this may happen. So it was PNL neutral. As we move along on a conservative basis, although we feel that and we strongly believe that the entire loss that was claimed is allowable for tax purposes, but on a prudent basis, in the current year, we've booked a tax provision against the profits that we've made, and we will have that decision taken by the tax authorities towards the second week of October, and know how we go ahead. So that's the story. I've tried to make it as short as possible, just for your understanding. If you have any further questions on the tax, I'm happy to take them.
Thank you, Deepak.
Thanks, Deepak. He shouldn't have raised his hand. Yeah, suddenly it disappeared. So just see.
Yeah. I think we may have covered it all because you've covered, we know that obviously there's always big interest in Dukkam, and I think one of the things that we've been very happy to be able to say is that we have seen that move of 1,000 more people coming in from the end of the first half. So that's a positive for all of us to take home. And then we have to take the balance of what Rashid and I have been describing, and when projects start, it's something around our hand, but there's definitely momentum for more to come, and that we will achieve going through that 6,000 before the end of this year. So that's positive. I think the other big positive is how the rest of the business is performing to compensate for this hiatus in the Dukkam, including starting to see the benefit of that expansion of our packs and so on. So as usual, your questions are on the button, and we know you take a great interest in that. We very much appreciate that, your interest going on. So, sorry, Deepak, you're asking about, you missed the point on higher finance cost. We can take that one, and maybe as the last question. Yeah.
Deepak?
Yeah, please go on.
Yeah, so if you see the repo rate that has moved from June of last year to this year, we from 5.5, it's gone to nearly 6. So our interest rate resets have been at a slightly higher in terms of basis points versus what we were running last year. So that has led to a small increase in our interest cost. And that is it. There's nothing else to it. It's just the interest rate reset and the refinancing that we did towards the end of 2023 for Dukkam. Those are the two things that contribute to it.
Okay, so I think on that note, as always, from Rashid and myself, thank you for attending this and for your interest in us, and we look forward to continued progress of this company quarter on quarter, and we'll see you next time to report on Q3. Thank you all very much indeed.
Thank you.
Thank you.